All right, Kyle. This is a topic we've talked about before. It's a topic that we will probably often talk about because it comes up so much. And today, how we're framing is navigating the risks of high yield dividend stocks.
Yep. They can be attractive when you see those big yields and you get a nice big dividend payment, but sometimes it's not always what you kind of see on face value.
I mean, so often I'll have a client email me or, chat me or whatever and say, hey, have you heard of, XYZ stock? It's got a 13% yield.
Yeah.
And I was like, never heard of it. I was like, let me see. And then I dig into it. I'm like, oh, it takes me like 0.3 seconds, and then we'll talk about it. So let's dig into this. But before we kind of get into the do's and don'ts and whys and thought process, let's kind of back up for a sec. And what is a dividend stock? I feel like we just talk about it all the time and just forget that not everybody knows what this stuff is. What is a dividend stock? So we have two stocks out there.
Yep.
We have stocks that pay dividends and stocks that don't.
Right. And traditionally that's your growth focus.
So the stock that doesn't.
They're using 100% of their profits to go back into the company and invest back in.
Or debts or loans or whatever.
They're running the business, where then a dividend is taking a set percentage of their profits and paying that out to their investors. So it's almost like you get to share in the profits of the company.
Yeah. So sometimes investors forget that, if you buy a stock, you're an owner.
That's right.
And, as an owner, you're allotted certain benefits. Like you can vote, you can do certain things. And with a non-dividend paying stock, your rights are a little bit less.
Right.
They're about the same. But you share in, a non-dividend paying stock would say, well, you're going to share in further growth of the company. Yeah. Well, okay, maybe. On this side, you get to share in that same growth, but you get to capture some of their profit, some of their income along the way, where you get actual paycheck as an owner. Like you're an owner of this, company XYZ, and as they make money on a quarterly basis, they're going to write you a check.
It's an investor getting immediate return of their capital that you're
sent.
letting them hold.
Yeah. And it's either going to get reinvested into more shares or literally sent to your bank account. It's real money.
Yes.
Because sometimes investors are like, oh, well, that's just on paper. No, it's
real.
Yeah.
I can show it hit your bank account.
Yes.
You can go spend it. It can be a date night for you.
We got a whole lot of clients that are watching it and are like, oh, it's real. Yeah. I've been spending it for a long time.
That's it.
Okay. So why do investors chase, or why are they so attracted to dividends?
Well,
high yield dividend.
High yield dividend, it just means if I get, take your example, if I've given $100 to a company and I've invested that and their yield's at 10%, that means I get $10 per share. But if their yield's at 1%, I'm only getting $1.
Yeah.
So on the surface, it's like, do you want $1 or do you want $10? Oh, you're going to take the $10, that 10% yield all day if everything's the same. But as we'll kind of uncover, not all dividend stocks and yields are created
the same.
equal.
Yeah,
that's right.
And the crazy thing is, if I'm just your average investor or a portfolio manager, what's more attractive? 1%, 5%, 7, 10, 15? I mean, how high can we go? And we're well, I want that one. That one, 15% looks way better than 5. Right.
Yeah, it's like, don't kid yourself. We want the 15 just like you do. We just have to make sure that we're doing the homework on the other side and making sure that it's the right type of company.
Yeah, so let's talk about some high yield traps. So first of all, we all know why we're attractive, because bigger is always more attractive than smaller, right?
That's right.
What makes a yield high and a yield low? Let's start there.
Well, it's a percentage of what their cash dividend payout
dollar amount
is compared to their stock price.
So if we have a $1 per share dividend and a stock that's $100,
that's a 1% yield.
1%. So we have a stock that's $100 a share. It's paying. So every share you own, if you own 10 shares, you have $1,000, and you have a 1% or $1. The percent is the relationship to the stock price. So if a company has instituted a $1 share, so if you have 10 shares, you get $10. If you have 1,000 shares, you get $1,000. Doesn't even matter what the price of the stock is.
Right.
So if the stock's $100, it's 1%. If the stock is $10, it's 10%. So the stock dividend didn't change.
No.
Okay. But the stock price got 90%. Crushed, dropped 90%. So now we have a 10% yield, even though nothing changed. Now you have to look at the inner workings of the company, like why did the stock drop that much or whatever. So and that's what we're going to talk about here.
Yep.
So dividends are not a percentage of what the stock price is that's paying you. It's a representation of the dollar amount as it relates to the stock price.
Right.
And I think a lot of investors get that's the yield. I think a lot of investors get that wrong. They're thinking, well, if I have a portfolio and it's worth 100,000 and I'm making, $5,000, there's a 5% yield on there.
Mm-hmm.
Well, if the stock portfolio goes down to 80,000, you still get $5,000 of yield of income.
Of income. Yeah.
If the stock portfolio price goes down to 50,000, you still get $5,000. And there could be all kinds of issues. Like if you look at the pandemic, portfolios market values dropped in a month. Like they just got crushed. And if you look at stock yields, dividend payouts, they really didn't move.
Okay? No, the payouts didn't, but their yields did.
The yields went just through the roof.
Skyrocketed, yeah.
So, but there was a global shutdown.
That's right.
So because these stocks pay a specific dollar amount and their prices move on a second-to-second basis when the market's open, it doesn't mean that the stock's good or bad. It just means there's volatility in the market. So you have to understand why stocks pay a low yield or why stocks pay a high yield to understand the trap mechanism behind that.
That's right.
Okay.
Yeah.
So let's talk about unattractive high yield stocks first. Okay. So we have a stock that is paying, a 5% yield. So it's a $100 stock and it's paying, $5 a share just to make it 5%, right? And now all of a sudden that yield isn't 5% anymore because the stock price dropped. And now that yield is 12%. So the stock price is in the 40s or something like that.
Right.
How can this be a red flag?
Well, if that many people are selling the shares of that company, there's typically something that's going on. And that's where you've got to really start digging in, reading reports, figuring out what's going on. And is it sector wide or is it just that company, right? So like if say it's an oil and gas company, because those are pretty good payers, energy companies. If that one particular company is really getting hit hard, is everyone else in that same sector? Is there something going on that's
What's
bigger?
The news?
Like the pandemic.
Yeah.
Like no one's using gas because no one can go anywhere. Well, the whole sector moved down.
Yep.
But then if it's just one company where maybe they are doing some things that are a little shady or they're not being a good steward of their resources. They're making bad investments.
Yeah, bad investments.
Paying too big of bonuses or all kinds of things that can go into that. But you really have to start lifting the hood and seeing what's going on in the engine of that
There could have been a changeover of a CEO. There could have been fraud in the company. There could have been bad management. I mean, there could be all kinds of issues. Just you can't look at a yield and go, I'm going to buy that.
Yeah, it could be a lot of debt that's maturing, because companies, it's okay for them to take on debt, but sometimes it gets stacked up and they can't refinance that debt or pay it down. And now they've got these huge balloon payments that they've got to figure out what to do.
And that's a scary place to be.
And that's a really scary place to be for a company.
So, all right. So is there anything else that we could talk about there that is a real world? Let me give an example. So you had AT&T. AT&T a couple years ago went through some massive changes, and they had been paying their dividend forever.
Mm-hmm.
Then all of a sudden they spun off a company, made some changes internally, and as a result they cut. And actually before that, their stock price was getting crushed, which their yield was looking awesome.
Yeah.
Right?
Yes.
For months and months, it was looking really, really good. And then, which everybody saw it coming because they're like, how can they sustain this?
Something's got to happen here.
And then all of a sudden their dividend got cut.
Yep.
And then their yield went down because their dollar amount per share got cut. And that's one of the dangers, and that we'll talk about. So when you chase high yield, you're exposing yourself because not all dividends are created equal.
Mm-hmm.
So when you see a stock dividend that's paying 2%, and one that's paying 5%, one that's paying 12%, they're not all the same strength.
That's right.
They're not all the same company. But we think, well, if the industry is really strong, then all of these companies are really strong. It's not.
No.
I mean, they're all over the map. So when you see these high yields, a lot of the time, they're literally on the brink of making a big change. And the biggest concern of that is a dividend cut.
Yeah.
What is that?
I mean, it's exactly that. They cut their dividend from what it was.
So say it's $2 a share.
And they may cut it to $1 per share to kind of get it recalibrated to where it was. Especially if you've got a company that their yield has gotten up to 12%, they may cut it to where it's now 6%, which is still pretty good. But if you've been investing in them, your dividend, your actual cash for that company's gotten cut in half.
Mm-hmm.
You know, we had a company recently, Walgreens, that was a part of our portfolio. They actually went a different route. They went back into private equity. Someone came in and just bought the whole company.
Yeah.
But they were in a serious kind of hurt there as well. And they were really on the cusp of reducing their dividend. I think they may have actually done it that last quarter.
Mm-hmm.
So
you've got a lot of issues that look at the risks of chasing high dividend yields, dividend cuts, sustainable business models, which are, you know, when there's a changeover of leadership and a new CEO is like, hey, we're going to do X.
Yep.
And you're like, well, that is so, you know, sometimes it's really, really good. You look at
companies that refuse to like change with the times.
Correct.
You know, they're just like, no,
like
we're
Kodak.
doing this.
When digital cameras came out, which they had started some of the technology, but they didn't see the future. They wanted film, and then they got left in the dust.
That's it.
You look at Apple. Apple parted ways with their founder, Steve Jobs, in the 90s, and they lost their way. And when he was a part of them, they had a very small product line, and they had a cult following. I mean, it was unbelievable. Then they fire him, and then the company goes from a very small offering to like 150 product offering. And sales were declining. They went from like 50% market share down to like 13% market share by letting their CEO go. Bad decisions, right? They weren't paying a dividend, but this is some of the things we're talking about. They bring him back in, and in his first year, they cut their offerings from like 150 or 120 huge offerings down to 10. And then the company grew to where it is today.
And now they pay a dividend.
And now they're paying a dividend. 2007, they issued a dividend. You've got volatility, downside risk. I mean, one of the big factors that we don't talk about often is how much of a stock, whether it's a dividend paying stock or a non-dividend paying stock, is owned by institutions. Because institutions really move the market.
Right.
So if you look at a company and it's owned, 60% of its outlying shares are owned by institutions, and all of a sudden that stock's getting crushed, you have to step back and go, what do they know that I don't?
Yep.
And a lot of time it's emotion. Sometimes it's political. Most of the time it's reality.
Mm-hmm.
And, what do I need to dig into? Why is this yield X? Now it's super high. It's attractive. When you see an attractive yield, you probably need to go back and go, what was that yield last year, 2 years ago, 5 years ago, and see how it got that high.
That's right.
And if it just all of a sudden just whoop, because the stock went like this, that needs to be a red flag almost immediately.
Yeah. The quick movements are the ones that make you nervous.
Yes. So let's talk about, again, some more red flags. Okay, so excessive high dividend payout. So when you look at a company that's, to say, over a 2-year period went from a 3% dividend to a 13% dividend. One of the things might have happened is because the way they're doing their books, their finances, might have slowly over time crept in. They overextended themselves over here and over there. And now their cash flow is shrinking. And as a result, their payout of the dividend is starting to creep up. Because we just talked about this earlier. Dividend is a percentage of their profit, right?
Mm-hmm.
Well, when they have shrinking revenue and overextending loans and debt and things like this, and now their profit's doing this, now their dividend percentage of that profit is doing this. And now we've got a big issue on our hands where they might have to start taking out debt to pay a dividend, which is a big red flag.
Or to run their operations, right? Because you just don't have cash flow to even pay your people. Or
cash flow determines everything.
That's it. That's one of your favorite markers when you're looking at companies and who we're going to invest
Free
in
cash
from
flow.
the portfolio. Yeah.
I want to know how
that's
much
the very
money they
first
got in
thing
the
you
bank.
always go look at.
Where's the free cash flow? So if you're looking at a dividend payout ratio, if it's greater than 75%, you need to understand why.
Yep.
It's not that it's bad.
That's right.
Because there are situations where you can have a 250% payout ratio for a short period of time, but there's legitimate reason, a merger, paying down debt, buying back shares. I mean, it's just a one-time deal where their books flipped almost overnight. Why?
All three. Yeah.
Yes.
Restructure the debt.
Whatever.
All kinds of stuff. Yeah.
If it's less than 75%, you're probably in a good situation. Declining revenue, which we've already talked about. High debt levels. This is a no-brainer. You think about your own financial situation, bought a new house, bought a boat, upgraded your cars, got a golf membership, whatever it is. And all of a sudden you're like, oh my gosh, we're capped out. And you go to take out a credit card and they're like, you get denied because you have no credit, or you want to take out
used up. Yeah.
You're like, the banks are like, nope, you're too high risk now. Well, companies have the same situation.
Yep.
Just a lot bigger number.
That's right.
Right?
Few extra zeros.
Negative cash flow.
That's like a huge red flag there when they're not able to run their business with what they're actually making.
Yeah.
And then they're continuing. And there again, it is a major red flag, but you have to understand why. If it's 1 year short term, they've made some more strategic moves and maybe they just really outlaid a ton of cash to get right side up, which sounds funny. But sometimes they can do that with restructuring and the way their accounting has to work.
Yeah.
But you need to understand why.
So let's switch gears and talk about giving some tips on smart dividend investing. So what would be the first thing that you'd want to share there? Anything?
Cash flow.
Free cash flow.
Go check that number. So no, honestly, but it is a really good tell sign of how strong that company is how much cash flow do they have?
Yeah.
Because that's where it's coming from. It's coming from their operating capital. They've got to have that cash to pay.
I say this often, and I'll continue to say it. I grew up in an environment where my parents used to tell me all the time, show me your friends and I'll show you your future. Who you hang out with is who you become. On the flip side, if you're talking about dividend investing, I would relate that thought process. Show me your financials and I'll show you your future. As an investor, if you can understand the strength of the company, their free cash flow, their debt position, their payments, their profitability over time, how much money they have in the bank, what do they have in cash equivalents, what do they have in expiring debt, all kinds of stuff. But when you understand the makeup of a company and you have good judgment based on that, you can almost predict, not entirely, what's going to happen in the future. So if you want to make smart decisions on dividend investing, understand the companies you own. Don't just chase where their price is. Don't look at their yield. Understand why they're paying their yield and the strength of their yield as it relates to the cash that's coming in and the cash they have in the bank and the debt exposure that they have. I don't want to say ignore their price, but if you really want to be a smart investor, make that the last thing you look at. Yeah. Once you get a good grasp on dividend investing, now you can use price as an advantage.
That's right. Now
not a motivator.
Now you're going to go look for opportunities of winning their buys.
Yes.
Yeah.
How can you swap and do different things?
That's right. I also like looking at their leadership, honestly, to see how much turnover they've had. Has there been a lot of not even strategic, but is there a new CEO or kind of a shift in mindset into that company, especially as their yield starts to creep up? Has that CEO been there for 15 years? Okay, he's probably going to do everything he can to prevent this yield from getting too far outside of itself, and he's going to protect the dividend. But if it's a brand new CEO and it's moving up, it's also kind of like one of those little warning signs too that he or she might have a shift of focus of how to make the company profitable again.
Yeah, when you get a new CEO in, it's always, you're on shaky ground now.
Yeah.
Is the company truly controlled by the CEO? Is it board of directors? How much turnover is in the board of directors? So if there's been a brand new CEO, has he completely changed the board of directors so he can get done what he wants to get done? Or did the board of directors bring in a new CEO and nothing changed in the board of directors? But I would want to know that, because that's going to tell me, hey, the CEO came in and there's a brand new board of directors. Hey, this is a brand new company and anything can change. Or, sometimes the companies are controlled by the board of directors. There's very little turnover and a CEO is just a new puppet.
Yep.
a new front face.
That's right.
So these are things you want to know. So we'll give one more thought, or your
I think the biggest
takeaway.
thing is truly, when we say this all the time, I feel like, but understand what you're investing in. Understand the company, understand their balance sheet, their fundamentals. And if it's a great, strong company that maybe just for a moment their yield has gotten high, then maybe that's an opportunity. But just because the yield's high doesn't always mean that that's the time to go jump.
If I were to leave you with a closing thought, it'd be two things. And it's really what this show is about. The first and foremost is not all dividends are created equal. That is first and foremost. Understand why they're different. And the second thought is high yields often signal high risk. Not all the time, but sometimes. Typically, the rule of thumb is the higher the yield, the higher the risk. The lower the yield, the lower the risk. Not always the case. In a lot of situations, you can have a low yield cut its dividend, and you can have a high yield strengthen its position.
Sure.
But rule of thumb is the higher yield often signals higher risk. So hopefully you enjoyed this topic that we talk about often. It's not going to be the last time we talk about it, but hopefully there's little bits of information you continue to take away from these shows to make you a smarter investor. Thanks for watching.